Hey everybody, it's Pete. Good morning. Welcome to Stocks for Breakfast. Today is Thursday, April 2nd, 2020. I want to start the video off the way we've been starting it off every day, which is I hope you're safe and I hope you're smart. I hope we're all doing what we could be doing to reduce that curve to get life back to normal as much as possible. I don't know about you, but I'm starting to go stir crazy being home. Today I wanted to do a quick lesson on something. We're going to discuss why most traders struggle. And I think that once you understand that, it's going to help you to be a lot more patient and a lot more disciplined. I know a lot of us talk about patience and discipline like it's some kind of superhuman characteristic. Like, oh gosh, that person is so disciplined. I couldn't be that way. Here's the key that I'm going to give you. And this is really, to me, it's $1 million key. When you understand that the reason, and let's assume that you feel like you have a good idea of what it means to look at charts, to read the tape. Let's just assume that. Whether how advanced that is doesn't matter. When you finally understand and accept the fact that it's the trades you should not have been in the first place, that's the reason you don't get paid, it'll wake you up like that, and you'll start to pay attention to say, do I really have an edge here? And I'm going to look at a bunch of charts right now that actually review that. But I want to ask you two things, actually. First thing, if you enjoy these videos, it would mean the world to me if you can click down and subscribe. The second part is we're getting some pretty good interactions in comments. If you don't mind, I'd like you to type in how long you typically hold a trade. Because we get a lot of back and forth, whether it's an email or the comments here on the videos, about what do you think about this, what do you think about that, and everybody holds trades for a different amount of time. And the current market conditions that we have right now, we're kind of all bunched up into a little bit of a shorter time frame. We're making decisions off of shorter time frames. We're holding trades probably a little bit quicker. Probably some more people day trading than they might normally because of the micro time frame that we're trading on, because the big picture is a little bit of a mess to the downside, right? Excuse me. Big pot of coffee already gone today. So we're in a bearish market right now, but one thing we have to keep an eye on in this bearish tape right now is it's 100% based on news, 100% based on the global economy, and obviously the global situation that we're all in right now. What if that story changes tomorrow? What if it changes today? I'm not saying it is, but what if it is? As traders, we have to start to say, if this happens, then I'm doing this. If this happens, then I'm doing this. So for example, you need to be saying to yourself, I'm making trades based on the news right now. Am I a news trader, and can I handle the increased volatility because of the news? So that's the first thing. The second thing is, are the stocks I'm trading really obvious to one side or the other, and how long has that been? Because the more obvious, and something that's important too is when I say obvious, I'm talking about you can look at a stock in a heartbeat and you could say that buyers are definitely in charge of that stock, or sellers are definitely in charge of that stock, and then you want to hop on their back. You want to piggyback what they're doing in a way that you could manage risk, and there's profit potential in exchange for that. A lot of stocks don't really have that right now. A lot of stocks are clearly down from when we started to collapse. Now we're kind of going sideways a little bit, and the edge has kind of shrank quite a bit. So what I'm going to do right now is I'm going to jump over to do a 90-second lesson on a PowerPoint. That's right, I'm pulling up a PowerPoint presentation. Wow, I said that. PowerPoint presentation by Pete. We're going to look at that for 2 seconds, and I want to burn this image into your mind because it's a really big reason why traders who are smart struggle. So we're gonna hop over there really quick. And essentially, this is what we're going to talk about right now. You can see this is actually a lesson that's in my masterclass. So I ask people all the time, what is the single biggest reason that smart traders fail? And when I say smart traders, I'm talking about you. I'm talking about you, somebody who knows what they're looking at, somebody who has confidence to open a trading account and get to the point where I'm going to accept risk on my hard-earned money because I got a feeling I know what I'm doing. And that feeling is based on, I'm looking at charts, and I'm pretty sure I understand what I'm looking at, right? Well, the single biggest reason that smart traders fail is the one mistake you make over and over again that pushes you further and further away from profitability. Now, here's what I mean by this, is when you're trading and you make this trade, and let's say it was a mediocre trade, not one of those A+ trades, but a mediocre trade. But you say, you know what? You kind of talk yourself into it, and at the end of the day, you're like, yeah, I guess I would do that again. But you know deep down it wasn't a good idea. You know deep down it wasn't one of those trades where you're like, oh gosh, I would put my grandmother's money in the tin can she has hidden in the closet and on that trade. That's the kind of trade you're looking for, where you would take your grandma's money, your grandpa's money, mom or dad's money out of the closet, and you'd be like, this is, oh my gosh, this is definitely going in that direction. So when you do that, this is what looks like, right? You take 10 trades, and this is the world that I live in. This is how I've taught myself and how I teach people in the coaching program. So I'm kind of giving you an advanced lesson, little peek behind the scenes, right? I teach everybody to look at 10 trades and say, over those 10 trades, if you have an edge and if you make perfect trades, so we're talking about A+ trades, all of your criteria is in sync, right? If you make 10 trades, some of them are going to be winners, some of them are going to be losers, but over 10 trades, you allow the sample size to play itself out, and we're using 10 as an example here, and the edge does the work. So if you have a probability of what can happen, and I'm going to come back to the screen here really quick. So over those 10 trades, you say trade 1, trade 2, trade, and you get all the way up to 10 trades, 10 perfect trades. Everything was, right? Your edge does the work. You're not doing the work. Your edge is doing the work. The probability of following through over those 10 trades works. Same, and I hate to use this, so I'm going to use this in full context. Listen to the whole thing. Don't say gambling. This is why casinos have 1,000 tables and not one. They're allowing their edge of 3 or 4% to play itself out over and over and over again, and over a large sample size, they should come out ahead based on the odds of how that game works. So all of those games work. Trading is very similar in that that's how computers work. That's how algorithms work, that they have an edge and they just keep doing it over and over and over again. They don't break the edge. They don't say, this time maybe I'm going to take it, maybe I'm not going to. They don't do that. They take every single one. So here's the image that I want to burn in your memory to really understand and learn what it means to take a good trade. So this is what happens when you make 10 perfect trades. Your edge does the work over 10 trades. Maybe it's trades 1, 3, 5, 6, and 9 that don't make money and the other ones do. It could be a random sample, right? But what happens if out of those 10 trades, you make 3 that aren't good? So you still made 10, but now 3 of them aren't good trades. Well, now you have 13 trades at a minimum that you need to make to get back to being profitable, to let your edge do the work. And that's assuming those 3 bad trades didn't blow up into big losses because of how bad they were. So this is actually essentially what it ends up looking like. You get into this endless cycle of being frustrated, and frustrated because you're smart, frustrated because you're like, I know what I'm doing. Why can't I make money? You always feel close, but you never get profitable because you start making all of these X trades, trades that aren't perfect. So the perfect ones are the bigger dots, right? All of these little small loss, small loss, small profit, small loss, small profit, all these trades you shouldn't have been in the first place. And now it ends up 20 trades later, you're at maybe 0, or maybe you made a little or lost a little, but you're certainly not profitable while the market's going straight up or going straight down, and you can't figure out why. This is why. It's all of those mediocre trades that you take that you shouldn't be in the first place. So what does that imply? What does that mean for you? How does that wisdom make you a better trader? The minute you realize these trades you should not be in the first place, the mediocre trades, the one you can't build a good argument for, the minute you accept the fact that that's why a smart trader like you can't get paid, you stop taking them like that, and all of a sudden you become disciplined, because now it's like, well, why would I take those trades if those are the trades that are draining my account? It's easy to, I feel like it's easy to make money when it's obvious. And when it's obvious, I put on those good A+ trades and my account goes like this, it goes up. But then when the market goes sideways and it gets choppy and I get frustrated and I hit my keyboard and I'm like, what's going on? Those are the trades that keep you from getting paid. If you want to get paid on a monthly basis, you need to have the structure to say, this is my A+ setup. And anything that doesn't match my A+ setup, I'm not allocating money because it doesn't make sense. The math doesn't make sense. So what I'm going to do now is we're going to jump into a quick look at a bunch of stocks, and you can take a quick look at that and say nothing or obvious. So interestingly, what I'm going to do though is I'm going to drop down to the hourly chart, the 60-minute chart, because because we're trading on this micro time frame right now, the market's gapping up and rallying and sideways and coming back down again. And you'll see in a minute, we're actually trading higher again today, which you would not have bet that, right? Coming into today, you would not have bet that the way the market closed yesterday, right? Which if you watch the video of best stock picks, all of the picks that I made were long yesterday. There was a reason for that. So we're going to get into, we're going to take a quick look at some hourly charts, and then I'm going to briefly touch on some longs that I like for today. And one of them that was actually weak the last couple of days, but is actually a buying opportunity today, despite the fact that it was weak. So we're looking at the SPY here. We're looking at obviously an hourly chart, and we're looking at basically most of March. So you can clearly see here we were in a longer term downtrend here in the SPY. Oop, clicked the wrong button. What's going on here? I'm going to start there and then draw this down. So when you're drawing trend lines, you want to make sure that if you start at the high or the low, you don't go through any price action, right? So if you're starting here, we use this. We actually found good resistance there, and this is where the trend line was broken. So technically now you'd be starting to draw another trend line, and you're going to go here. So in the period of this month, we had a solid downtrend, then we had an uptrend, and now we went sideways for a few days. And then we got down, and then we went up again. The market is not obvious on a longer term picture. If this was obvious, we'd be rallying and clearly pulling back. We'd be rallying and clearly pulling back, which we kind of did over here. But we had these gaps, these monster story gaps, right? Basically, what I'm saying is the market is kind of all over the place right now. So within, and you can see here from last week, quite a few people writing in saying, I'm not sure what's going on, sending me emails, which I'll post my email below if you have questions. When the market is back and forth like this, and the news is volatile, and the expansion and volatility of the stock, and the news is volatile and stocks are volatile, which is increasing the risk profile, it's best to do one of two things. Step aside because it's not a perfect trade. Number two is if you do decide to get involved and you feel like you put a perfect trade on, because of the increase in volatility, it's imperative that you reduce the amount of shares or contracts that you trade to compensate for wider stop losses. Trading more size or more contracts in anything that you feel is an A+ trade is just dumb. There's no reason to do it. You know, getting back to this picture of what this looks like when you make yourself struggle. You, again, if you don't like what you see in the mirror, don't blame the mirror. This is us. When I finally realized this, everything changed for me because now I was like, all right, that's not obvious. Why would I put a trade on? That's what's going to stop me from getting paid. So I just wanted to point that out in a few stocks, you know, especially to take a look at a stock like Tesla. You can see it was in a 5-day trading range. Amazon, very similar, multiple day trading range and pulled right back in. And that's a big thing too, and we can actually discuss an Apple in a second as well. When a stock breaks out and should follow through, because if you remember on the daily charts, this was a pretty significant resistance level, which we could take a look at here again. We actually failed at that level. So failing at that level and reversing, that's not what you want to see. And we've talked about it quite often. What you want to see in a breakout is follow through. Real breakouts follow through. So I'm often asked, where's my stop loss on a breakout if it fails? You get out if it fails. If it breaks through and fails and comes right back in, get out. That's not what was supposed to happen. Again, the discipline of what you're supposed to do. So I thought it was kind of important. We can even take a look at Home Depot. Somebody had asked about Home Depot. Elv actually asked about Home Depot. Home Depot basically went sideways after a gap down, a gap up, and we went sideways pretty much. Now again, it's $14 sideways, maybe a little bit more, maybe 20. But is there an obvious trend here? You could make a case that you're trading the trend, but how long is that trend? The trend is 3 days. Think about that. You're trading a trend that lasted 3 days. So if you get into talking about what we've been discussing on the higher time frames about using the weekly candlesticks, so regardless of whether this candlestick is red or green right now, we have an inside candlestick. So we're kind of consolidating right now on a lot of these monthly candlesticks. So if we look at Facebook, we look at IBM, a lot of these stocks are inside candlesticks right now. So nothing new has happened as far as do we want to be long or short. So that means now that we, as traders, we're dropping down to the weekly chart looking for clues because the monthly candlestick right now is an inside candlestick. So if we're trading inside candlesticks, now we have to find stocks that are well bid or well offered and strong in that direction or weak. So we got a little bit of conflict here, despite the fact that NVIDIA is well bid, higher highs and higher lows, higher highs and higher lows, and broke this hourly downtrend. It actually this week is negative. It's bearish. So you would look for this stock to turn positive in the context of this being well bid before we started to. So I wanted to touch on that. One thing also, we had a good question about accumulation and distribution. And I'm gonna finish the video on that, but I want to get into a couple of stocks that we could take a look at today. This stock, Myrna, has been very popular, and I mentioned a couple of days ago. To me, right now, in the context of the way I look at it, the stock is a mess. It's trading on the news every day, and there's a reason for it: coronavirus clinical trial. So this is a stock to keep in mind. I'm not saying to trade it today, possibly looking for something that could explode, which it actually has had. If you go back to the hourly candlestick, you can see that there's been some powerful days where it has been tradable. But from a bigger picture perspective, again, from a probability perspective, are you trading this or are you trading this where it fits one of your 10 perfect trades? Probably not this right now, but absolutely something to keep an eye on, because this is a stock that's in play. And if we finally do get above this 31 and we are well bid like this, you could probably trade along for a week, and maybe even more, and get an explosive move if it does. A couple of other bullish stocks we're looking at today. DocuSign, we said above 92, we like. Chewy actually is one of my favorite trades for today, because we actually burst out of resistance, and now 34 should be support. So I'm looking for Chewy to open flat, push lower, look for a spot to bid with a limit order here, and then push higher. If you didn't happen to catch yesterday's video, we're looking at the last move for clues on profit potential, and we basically went from, let's call it 30 to almost 40, so roughly $10. So if we $9 or $10, let's say 9 for argument's sake to keep it a little bit simpler. If we pull back to 34, we'd be looking for 43 to be the profit target, and citrox as well. We're looking for it to get above this level. The reason citrox is in the list today is you can see it's got a little bit more obviousness. I don't even know if that's a word. To how much it's been bullish, and probably see that a little bit cleaner. Look at that on the weekly charts. We have 1, 2, 3, 4 weeks of bullish price action closing above the open. So we know that this is the resistance level up here. Actually, you know what? Let's actually pull that down. So we need to get above this level, and we need to get above Monday's high to look for a good, solid A+ trade in citrox. So those are the stocks that we'll be looking at today. The market, actually, you know what? The market is actually opening higher today, believe it or not, which is surprising. Actually, right now it's higher, which is really super early, a few hours before the market opens. The unemployment numbers are going to come out today. They're obviously expected to be horrible. The thing to keep in mind is, regardless of whether we rally right now and how long we rally, if we actually hold the rally. So for me personally, I'll be looking at those weekly setups that we just discussed, and in the individual stocks, I'll be looking to see which ones are bullish, which ones are bearish, which line in the sand by reading the tape has to cross one side or the other for me to say, okay, the week now is bullish or the week now is bearish, and then look at those stocks on an individual basis. So make a list of those stocks for yourself right now. Going forward, when we come out of this as a country and as a world, it's going to be tough to have a really good balance sheet for a lot of these companies. So we can kind of expect to most likely have a bearish movement for the second half of 2020. So it's probably good that you're learning how to make some money right now on the shorter time frame basis to compensate for what you might be taking as a hit in longer term portfolios. So I'm going to post a video in the description or in the pop-up, depending on how it works. I'm still figuring out how to use it. Somebody had asked about accumulation and distribution, and specifically in the CCL and RCL, the cruise line stocks. Accumulation and distribution is not something that happens quickly. It's when, after a large move to the upside or to the downside, over time, stocks are bought or sold. And that's not something that happens overnight, and it's not something that happens at that exact spot. A better clue of accumulation is when stocks kind of go sideways and the trading range gets tighter and tighter with heavier volume. We quite haven't seen that yet, but we have seen that explosion in both of those stocks, where there has been kind of sideways for about 2 weeks, but not quite a tight price action. So if you want a really detailed lesson on that, I'm going to post a video in the description. It's roughly 25 minutes, I think. definitely worth your time. And if you have some questions about it, you can post some comments as well. And again, if you want to participate and you don't mind being, posting it in the comments, let me know a little bit about yourself and how long you typically hold a trade. So I hold trades X amount of days. That would be kind of cool, and we can have a little back and forth discussion. So I'm Pete Renzulli. Thanks for watching Stocks for Breakfast today. Hopefully this is worth it for you. And the daily lessons, you're writing some good notes, because I'm hopefully giving you some stuff maybe that you can use and implement immediately to see your account grow steadily, right? If you do like the videos, please subscribe. And again, please be safe. That's the number one important thing in all of our lives right now, is being safe and being smart, so we can get that curve down and we can all get back to some normal life. So have a great day, everybody. I'll speak to you soon.